Even though the U.S. Federal Reserve has embarked on its rate-cutting cycle, there have been some interesting moves in the bond market when it comes to borrowing costs. Joining us now with more is Scott Colbourne, Managing Director and Head of Active Fixed Income with TD Asset Management. Scott, great to have you back on the program.
Great to be here, Greg.
The older I get, Scott, the less I understand the world. As we said, the Fed has embarked on its rate-cutting cycle, gave us 50 basis points right out of the gate, and bond yields were pushing higher through the fall. What is going on out there?
Yeah, basically they cut 50 basis points, and since that point, 10-year yields in the U.S. are up about 65, 70 basis points. So a bit counterintuitive, but I think when you look back, when they started embarking on their cutting cycle, there was some data at that point that sort of underscored a need to maybe get closer to neutral. Since that point in time, the economic growth environment globally, especially in the U.S., has gone up. We look at surprise indices, and in the U.S., those are measures that, relative to consensus forecasts, they've surprised on the positive side. It's been a one-way move basically since August. Inflation, there's some concern in the market that that momentum or deceleration on inflation is sort of ebbing here. So a little bit of concern on the inflation side. And then I think that there's a building of a term premium for fiscal risks. And that sort of encompasses a big package, the election, and the concern as to what happens post-election from both candidates and what it means for bond issuance and deficits.
Would we expect when we get a result from the U.S. election, who knows how long it will take, depending the polls telling us it's very close, get a little more clarity for the bond market? Or as you said, in the conversation we've had, and you and I have had them too, about both camps in the U.S. election, no matter who takes the White House and who controls the Congress, they both have big spending plans. This would be of a concern, I imagine, to the bond market.
Yeah, and I think that's what you're seeing built in, right? It was a Committee for Responsible Fiscal Budgets put out an estimate that Trump administration would be about $7.5 trillion extra spending, and the Harris camp $3.5 trillion. Whatever the numbers end up being, the direction for both camps is basically more spending, more deficits, given this sort of Goldilocks economy where good growth, solid labor market, moderating inflation, and you got large deficits. It's sort of counterintuitive to history, and so yeah, the term premium builds up. There is an expectation after we get through, the administration gets in January, whoever it is, that we're going to be dealing with a lot more issuance, and so we're definitely feeling that pressure on the longer end of the bond market, and I think that's a reasonable expectation for the markets.
Now, another term, obviously, that I used to understand the meaning of was bond vigilante. They seem to have reared their head a while ago in Britain when they didn't like their fiscal plans. Would they take on the U.S. debt market, like the largest, most liquid debt market in the world? Or?
I won't say no. I never say never in investing, but you've had stresses in the UK, as you correctly point out. We've had stresses in France, right? In the OAT market. The spread relative to bonds has widened out too. A little bit of action last week felt a little disorderly, if you will. You had a soft employment data print, and you got a sell-off, right, in the bond market, a meaningful sell-off on Friday. So I'm not saying no, but I do think that the combination of the Fed as well as the Treasury would sort of look at managing the risks to supply issuance, and they've been fairly crafty. I would use that word in terms of skewing the issuance to T-bills relative to longer end, and that's sort of kept the yield curve in check as the Fed started to ease. So I worry about that going forward, and it is a pressure, and it is a risk. But in the near term, I think it is opening up opportunities for investors.
Let's talk. First we'll talk about the Fed, then we'll get back to the bond market and what it all means, because obviously we have the Fed on Thursday, we have the election on Tuesday. It is a busy week. What's the expectation there from the Fed?
I think the markets, and we believe that's 25 basis points. It's not a forecast meeting, so there's a summary of economic projections, the SEP. It's not coming out at this meeting, so it'll be just Chairman Powell managing and messaging the markets. Obviously, I think they've struck a balance to say, the risks are equal for both inflation and growth here. So, they're prepared to, just stay on path. They indicated 25 basis points in November and December, so there's no reason to expect them not to do 25 basis points post-election. But I think, going forward, it'll be very data dependent, and certainly it'll be dependent on the administration.
In hindsight, the 50 right out of the gate, did that make sense now in hindsight?
No.
No.
Clearly, I think they were too much in the team transitory when they started to hike, and I think they were too eager and too narrowly focused on the short-term data at that point in time to come out with 50 basis points. I think the market's telling us, look, if you're easing and you're trying to get back to normal, you have to be a little bit more cautious, and so. Maybe we get a sense that they pause in December. Given the reactions, it's not my central tendency right now, but yeah, they have to be mindful of what the bond market is telling them.
All right, so let's put that all together and talk about the bond market. What it's trying to tell us as bond investors? What do we need to be thinking of?
There's a variety of things you can think of. I mean, obviously, how it fits in your portfolio. I like to say that as bond yields go up, it's an opportunity, right? Bond investors can lock in good yields depending however they invest. So I'm enthused by the opportunity for investors to get involved, and certainly credit corporate bond market looks very attractive. It will continue to be attractive, good growth. Balance sheet's in good order in the investment grade land. So the opportunity to pick up incremental yield, particularly in the front end of the market, is a great opportunity. So I'm mindful of, there's opportunities in this stressed environment as bond yields are coming up. And I think that ultimately, investors will get opportunities to see inflation coming down and growth moderating in the first half of the next year.